Margin in Forex isn't a fee, it's a deposit, and one number decides if your account survives.
Margin in Forex isn't a fee. It isn't a cost. It's a deposit your broker holds against the risk that your trade moves against you. Get this wrong and you don't lose to the market. You lose to the math. The number most retail traders watch is leverage. The number that actually decides whether your account survives is different. It's the stop-out trigger. In the EU, that's 50%. We'll come back to it. First, how margin is actually calculated. It's the percentage of a position's notional value you put up to open the trade. Take one standard lot of Euro USD. That's 100,000 euros of exposure. At 30-to-1 leverage, the cap ESMA sets for major pairs, you need 3.33%. So on a USD denominated account, you multiply 100,000 by the current Euro USD rate, then by 0.0333. That gives you your margin requirement in dollars. Most brokers run a calculator inside the platform that does this for you. Run it yourself once in a while anyway. Rounding and currency conversion produce surprises, and surprises in margin become margin calls. That 30-to-1 cap is only for majors. The full ESMA picture is wider, and the gaps between instruments are bigger than most retail traders realize. Majors like Euro USD and GBP USD 30-to-1, 3.33% margin. Minors like Euro GBP or AUD CHF 20-to-1, 5%. Exotics like USD TRI or USD ZAR 10-to-1, 10% margin per position. Major indices like the S&P 500 and DAX 20-to-1, gold 20-to-1. Oil and other commodities, 10-to-1. Individual stocks, 5-to-1, so 20% down to open. And cryptocurrencies, 2-to-1, 50% margin. Why the spread? Because volatility scales with margin. The broker isn't being generous on Euro USD. They're pricing the probability a 3% move wipes you out. On crypto, a 3% move happens before breakfast. Okay, that's the static picture. Here's the dynamic one nobody warns you about. Margin requirements rise over the weekend. On Fridays, many brokers raise overnight margin on indices and exotics by 2 to 3 times. The mechanism is simple. Markets gap on Monday open. A flash event in Asia at 3 a.m. Sunday becomes a 4% gap on your CFD position, a position you can't stop out of because the market is closed. So the broker forces you to hold more collateral against that gap or close the position before the weekend. Size a Friday close trade using Thursday's numbers, and you can be force liquidated before Monday opens. Check the weekend margin policy every Friday. Those caps assume you're a retail trader. Tick the professional client box and the picture changes, hard. Under MiFID, you qualify as professional with roughly a 500,000 euro portfolio, 10 or more trades per quarter, and documented financial services experience. Tick that box and the caps come off. Majors jump from 30-to-1 up to 500-to-1 at some brokers. That's 0.2% margin instead of 3.33. Minors go to 200-to-1. Indices, 200-to-1. Sounds like a leverage upgrade. It isn't. Here's the trade. You lose negative balance protection. You lose investor compensation eligibility. Your account can go below zero, and when it does, you owe the broker the difference. A retail trader can lose their deposit. A pro client can owe more than they ever deposited. That's not an upgrade. That's a liability transfer. That phrase, negative balance protection, is doing a lot of heavy lifting. Let's pull it apart. In the EU, UK, and under ASIC, NBP is mandatory for retail clients. If a flash crash moves faster than your stop-out can execute and your equity drops below zero, the broker absorbs the loss. Your worst case is a zero balance, not a debt to the broker. It sounds like a regulatory formality. It isn't. January 2015, the Swiss National Bank removed the euro-franc floor without warning. The market had assumed that floor would hold for years. It didn't. Euro CHF dropped roughly 30% in minutes. Stop-outs didn't fire. The market moved faster than the order book could keep up. Thousands of retail accounts went deeply negative. The brokers who honored NBP and absorbed those losses kept their clients, kept their licenses, and most of them grew over the next decade. The brokers who couldn't pay, several went bankrupt within days. NBP isn't a marketing line. It's the line between your broker being solvent and your broker being a court case. One catch. Offshore brokers, Seychelles, St. Vincent, the usual addresses, aren't regulated to provide NBP. They offer it contractually instead, which sounds the same. It isn't. Read the contract. Several offshore brokers offer NBP with a small carve-out, subject to abnormal market conditions. That phrase has been invoked repeatedly to deny payouts on exactly the kind of crash NBP is supposed to cover. If your broker's NBP lives only inside a terms and conditions PDF, you don't have NBP. You have a clause that gets reinterpreted the day you need it. Which brings us to the discipline side. 5 margin rules that separate traders who survive from traders who don't. 1. Never let your margin level fall under 200%. That's not a regulator's line, that's a discipline line. It leaves room for an adverse move without triggering an alert. 2. Size your position against your stop-loss distance, not against available margin. Margin should be a constraint you rarely hit, not a budget you spend. 3. Account for the Friday hike when you're holding through the close. 4. Factor in every open position when you size the next one. Used margin compounds across the whole book, not just the new trade. 5. Check your broker's stop-out trigger. In the EU, it's 50% of required margin. In the US, it's around 100. Offshore, it varies wildly. So, what do you actually do with all this? 3 things. Open your broker's platform now and find 2 numbers, the margin calculator and the stop-out level. If you can't find either, that's a problem. Then pull up the weekend margin policy and read it before next Friday's close. Then, if you're holding more than a couple of positions, check your aggregate used margin, the whole book number, not the per trade one. That's the number that triggers a margin call. And remember the 50% we opened with, the EU stop-out trigger. Here's the counterintuitive part. A lower trigger sounds friendlier. It isn't. It means more of your account is gone before the broker closes you out. Higher trigger, smaller loss. Margin is the constraint that keeps you in the game long enough to be right. Treat it like a fuel gauge, not a credit limit.
Margin is a fuel gauge, not a credit limit. Full breakdown linked in the description.